Hi, good afternoon, everyone. My name is Wayne Nguyen, and I'm an Assistant Vice President at the Community Development and Engagement Function for the Minneapolis Federal Reserve Bank of Minneapolis. The Community Development and Engagement Team supports the Minneapolis Fed's mission to pursue a growing economy that works for all of us. Through policy analysis, applied research, and convening, we inform public policy discussions. I'm pleased to welcome you to our webinar centered on recent research exploring the impact of multifamily property insurance on housing supply and affordability. We've heard a growing concern from many sectors that changes in property insurance premiums and deductibles may be affecting owners and operators of multifamily rental properties. As we tried to measure the problem, we discovered that little data exists. To quantify and better understand the current state of property insurance premiums and deductibles and the impact that could have on low and moderate income people and communities, the Minneapolis Fed surveyed multi-rental property owners and operators in fall 2024. Deepening our research and understanding through convenings like these is a critical part of our team's mission of advancing the economic well-being and low-income and moderate income people and communities throughout the Ninth District. In our time today, we will present our findings and bring together a panel of practitioners and subject matter experts from housing owners and operators, government, and the insurance industry to discuss our research and what they are seeing on the ground. I'm pleased to be kicking off this conversation. Thank you for joining us, and now I'm happy to introduce Christina Spicer, who will provide an overview of our research findings.
Thanks, Wei, and hello, everyone. I will be presenting our results from our most recent survey about multifamily property insurance. Also, I did not do this work alone. Libby Starling, who you will hear from later on in today's event, also worked on this research. As a disclaimer, the views expressed here are the presenters and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. Also, I just want to begin today by thanking our survey respondents. We received responses from 35 owners and operators of multifamily rental housing in our ninth district, including Minnesota, Montana, North Dakota, and South Dakota. Our numbers reflect responses from the 26 respondents with housing in Minnesota today. Also, thank you to those who shared our survey, including these organizations and a student team from the Humphrey School of Public Affairs. So last year, the Community Development and Engagement Division here at the Minneapolis Fed talked with an array of multifamily property owners in the Twin Cities and in Greater Minnesota, large and small, for-profit and nonprofit, market rate, and affordable. And we heard similar stories over and over. First, property owners are seeing dramatic increases in their property insurance costs. And secondly, owners we spoke with are paying notably more than they used to for coverage that will leave them more financially exposed should they need to use it. So, because of these anecdotes coming from Minnesota, we wanted to find out more about how today's current property insurance trends are affecting multifamily housing. And what we found is that there was and still is limited to no quantitative data on how property insurance costs are affecting multifamily housing. Because of this lack of data, we released our own survey this past fall, and we heard back from 26 multifamily housing owners and operators with units in Minnesota, who together operate around 35,000 total units. Most of them operate Class C, which we define here as older units with less amenities and naturally occurring affordable housing, or NOAA, and or income restricted affordable properties. Also, it's important to note that these results today are a snapshot of experiences. We relied on collecting a convenience sample of multifamily housing owners and operators, which means that we relied on our connections within the community and in the state to distribute our survey, and we did not randomly select property owners or operators. So because of this, it is important to interpret these results cautiously. Also, just for the rest of the presentation today, if I refer to owners singularly, I probably also mean owners and operators. To begin with, we asked our survey respondents about their experiences with insurance premiums. And we see that premiums increased consistently between 2022 and 2024. In the chart on the left-hand side of your screen, you'll see a chart that shows changes in property insurances premiums year over year according to our survey, with gold representing the average and teal representing the median. In 2022, premiums increased by 12% on average, in 2023 by 22% on average, And then in 2024, premiums on average more than doubled with an increase of 52%. One owner shared that we estimate that over 50% of our overall operating expense inflation since 2020 can be explained by property insurance premium increases, where property insurance increased from 6% of our total operating expenses in 2020 to a forecasted 14% in 2024. According to owners, insurers are increasing their premiums as a way to lower their own financial risk. And insurers use various reasons for why properties are perceived as high risk and warrant higher premiums. We asked specifically about 5 explanations, which you'll see here in the chart. And as you can see, the most common explanations for premium increases, according to our survey respondents, are severe weather risk, claims history, but then also one geographic difference that we saw in our survey results is that several property owners referenced a geographic difference between how insurance companies are treating properties within Minneapolis and St. Paul and outside of these two cities. Several owners reported that insurers are concerned about crime rates and also the civil unrest that took place in 2020. So also security is another explanation to keep in mind. Next, we asked our survey respondents about their experiences with deductibles. And we see that deductibles sharply increased between 2023 and 2024. In the chart on the left, you'll see a similar formatting to the first chart I showed you. With, instead of premiums, here it shows changes in property insurance deductibles year over year, gold representing the average again, and teal representing the median. So in 2022, on average, deductibles increased by 24%, in 2023 by 33%, and then between 2023 and 2024, deductibles increased up to 481%. This includes one significant outlier in our data set. However, even by excluding this one outlier, our property insurance deductibles, according to our survey, increased by 167% on average. And there are 2 possible explanations for why we are seeing increases in insurance deductibles. First, the insurers might be increasing the deductibles to show that properties are considered higher risk. Or secondly, property owners can be increasing their deductibles as a strategy to lower their premiums. However, this strategy leaves many property owners in precarious positions in the case that they do experience events of damage, or they now have to reserve more cash and have more cash on hand in case of an event of damage, which limits their ability to recapitalize and invest in future projects. One owner shared, "We are being forced to take on deductible limits that are far too large for small rural properties, and most of the portfolios like ours are just one claim away from significant financial stress." So about just under 50% of our survey respondents increased their deductible as a way to lower their premiums and mitigate insurance costs. But this is by no means the only strategy that owners and operators are using to respond to these higher premiums and deductibles and insurance costs in general. Here you'll see a chart that shows all of the specific strategies we asked about in our survey. And the most common strategies include fixing issues in-house instead of making a claim, decreasing other operating expenses, and the most common strategy, according to our survey respondents, is to seek additional bids and shop around for cheaper policies. Another strategy of note is that over 50% of our survey respondents with housing in Minnesota increase their rent, if allowable, as a way to mitigate insurance costs. Which leads to my final point, is that these current insurance costs and trends in insurance costs are causing a certain amount of property owners to increase their rent, which is a direct link between today's insurance costs and housing affordability. However, in general, several of our owners who responded to our survey are concerned about multifamily housing, and especially affordable housing properties. One owner shared that they could not shop around for cheaper policies because people simply did not want to give them quotes because of their operations, which was low-income housing and providing nursing care. A final quote I'll leave with you all is from one owner who shared, "If property insurance continues to increase at its current pace, operators will have less financial incentive to build and maintain affordable housing." Thank you so much for listening to this summary of our research. If you're interested in learning more about what we found in our survey, please seek out our article, Rising Property Insurance Costs Stress Multifamily Housing. Also, if you're interested in learning what we heard last year, feel free to seek out those two articles, which Talia will be posting in the chat. Also, feel free to keep in touch with us here at the Minneapolis Fed and the Community Development and Engagement Division. Thank you.
Thank you, Christina. And with that, I am pleased to welcome our reaction panel to the screen. I'll start off by providing some brief introductions of our four panelists. In alphabetical order, we will start with Commissioner Grace Arnold, who leads the Minnesota Department of Commerce. She was appointed by Governor Tim Walz in April 2021 and reappointed in January 2023. Prior to her appointment as commissioner, she served as the department's deputy commissioner of insurance. Second on our panel is Aaron Cocking. Aaron is the president and CEO of the Insurance Federation of Minnesota, a role that he has held since 2019. In this capacity, Cocking advocates for the interests of property and casualty insurance companies doing business in Minnesota. Prior to leading the IFM, he was the president and CEO of the Minnesota Association of Farm Mutual Insurance Companies. So we have two people on our panel who are well-versed in what's happening in the property insurance industry. And then we have two people on our panel who are well-versed in what's happening in the housing industry. First, we have Steve Min. Steve is the Vice President and Chief Financial Manager of Loopy Development Partners. Min also has more than 40 years of experience in both development and state and municipal government, including serving as the State Commissioner of Public Service and State Commissioner of Commerce. So two present and former Commissioners of Commerce on our panel. And then finally, we have Laura Russ from Aon. Laura is the Chief Real Estate Officer for Aon, where she oversees housing development, property operations, and asset management. She is a board member of the Minnesota Multi-Housing Association, as well as Housing League. So I'm sure you'll all agree that we have an array of experts who are well positioned to react to our survey findings and to contemplate what some options might be moving forward. So with those introductions, I'd like to turn to Steve first, our resident for-profit developer and apartment owner. So first of all, we thank you and the Loopy development team for responding to the survey. So having heard those responses, being in a position to compare that with what you've been seeing, what jumps out at you from seeing the entire array of responses from Minnesota property owners and housing operators? And how do these broad experiences compare to your own experiences as an owner of both market rate and affordable housing? Steve.
Well, Libby, thanks for having me here. I can concur with the survey results that the general premium increase from about 6.5% of operating expense to 14% is very much what we see in our portfolio, both the affordable and the market rate. I would say our overall premium increase in the last 4 years is about 100%. But I think there's some more detail to what's underlying that I'd like to share that I think is, sort of pull the sheets back a bit. There's a double whammy going on, not only rates per thousand going up, but the insurance market is starting to aggressively move on building values. I think outside of the realm of normal, there's a move afoot to put replacement costs, which all of us with loans have to buy, somewhere in the neighborhood of $325 to $350 a foot for replacement, which is easily $100 more than what it costs us to build in the current market for wood frame. And I think a lot of the new entrants to the market are giving us as buyers of insurance sort of a take it or leave it on their values. That's a major issue in the market. I can concur with the assessment about deductibles, particularly the absence of availability of wind hail at any dollar amount. It's all moved to a percentage, 3 to 5% in some cases, and this has absolutely nothing to do with experience rating. It's totally risk management by the insurance providers. I've got almost no risk experience in my 2,000 unit portfolio from wind hail, and yet I'm really getting dinged across the board. So, options that people are seeing, like moving to surplus and excess lines, part of what's driving cost is that that type of insurance carries surplus lines tax, broker fees, group membership requirements to join a program that offers surplus and excess lines. That's a cost that's included. It's not just dollar value of replacement. We're seeing a large amount of exclusion on the properties themselves, actual cash value instead of replacement on roofs over 10 or 15 years. You know, it's just getting impossible to get replacement on a roof if your building is 15 years old or more. There are even restrictions on green roofs and solar panels. So government's been encouraging all of us who build to put green roofs and solar on our roofs, and now we're being penalized insurance-wise for having those. And I'm in a couple of buildings, I've been told by my markets, I have to remove my green roof if I want coverage. So it's a double whammy. The last thing I'll mention, then we can, maybe share some other thoughts, is the ability to get quotes for competitive has really been compressed because underwriters at various markets are not sharing their rates on renewal until about 12 hours before my policy expires. So I literally have almost no time to shop. If I get 2 or 3 bids, they all don't want to be competitively outbid. So we get no data from our underwriters until almost, the expiration of the current policy. And we have to make a judgment decision within a half day. So those are some of the things that I see from the survey that I can concur for you.
Thank you, Steve. Now I'd like to turn to Laura, our nonprofit housing operator. Again, we thank you and Aon for responding to the survey. But the same question to you. What jumps out at you? What do you see in the results? And how do our survey results broadly compare to Aon's experience as an operator of affordable housing in Minnesota?
Yeah, thanks so much, Libby, and to the Fed for doing this survey. I think it's really helpful when the Fed and others play this role of connecting the dots between individual housing providers' experience and really what the whole industry is going through. So certainly everything in your survey and everything Steve said, I would concur with. I can speak a little to the nuances that are specific to the nonprofit and affordable world. And I really think of that not so much as nonprofit versus for-profit, but really we operate primarily income restricted housing as opposed to market rate housing. That's not to say that many private owners don't also operate income restricted, but in terms of insurance, that's really probably the primary difference. And in the income restricted side of operations, the most obvious thing is we can't raise rents in most cases. So we are restricted in our ability to recover losses through rents. In our local case, we have certainly had some state and local help to buffer some of those increased expenses, not only insurance, but some of the additional increased operating expenses. And that has helped get us through this period, but we still are seeing the same types of losses. And we are going to need to find new solutions for that. One thing that is unique about us as a nonprofit and is somewhat specific to Aon is we are part of a national self-insured captive as a nonprofit. I can speak to the sense as both a carrier and in essence an owner. That works really well when losses are low and the market is overpricing. It is not working so well when losses, as I'm sure Erin will speak to, are really what is driving up rates. And that is reflective in our experience, not only as a carrier, but as an operator. One thing I think is very remarkable in our own portfolio as I look not just at our reported losses, but at our incidents. So that could be sort of anything outside of what we had typically budgeted for or expected to see in our operations. So 67% of our incidents are actually below deductible in the last year. So that means that really this is not even the majority of our unanticipated losses that could be classified as insurance losses, but we are not filing claims for, are actually things that we're having to absorb. And that I think has been a big change, although I don't have the data going back, prior to the last 5 years. I think that's a combination of increased losses and increased deductibles. And now essentially insurance is functioning for us as a really only for catastrophic events. And that is causing a lot of strain. The last thing I will add, and we can get into more in some of your further questions, Libby, is that looking at our own, again, incidents, not just what we've reported to our insurance carriers, but 43% of our incidents, our losses are actually resident or guest caused. And I think that just shows some of the compounding impacts of general social disorder, security, some of the systems changes that have resulted with the way that particularly supportive housing gets funded and the way people come to us when they are on the list for us to be housed. They may be at an earlier stage of true readiness to be housed and may need a different type of support system than independent housing providers can provide. And we're seeing that in the form of everything from the classic residents leave their windows open when it's 20 below, to tubs overflowing because people fall asleep or are under the influence, the kind of non-criminal but really significant events that are directly related not just to resident education, but in some cases to the general distress we're seeing in our resident population.
Thank you, Laura. And Steve, I saw some knowing looks on your face as well, hearing that. Now I'd like to turn it over to Erin, who represents the insurance industry perspective. So having heard all of this, would you contextualize these findings in terms of how property insurance works? And in particular, could you talk about what the insurance industry sees as some of the key cost drivers that are driving these increases in premiums and deductibles?
Yeah, thanks, Libby. I think this is such an important question because of the many misconceptions about the factors behind premium increases. The simple truth is premiums are increasing because of the rising cost of claims. Insurers work hard to predict the losses they'll face each year, but when actual losses exceed those predictions, premiums have to rise to cover the difference. Rates have to be sufficient to cover these potential claims and the administrative costs so that it ensures the insurer's solvency and their ability to pay claims. I hear from people a lot about how they've never had a claim and it isn't fair that they have to pay more. And I have to remind people that insurance is not a savings account. The risk is spread to the entire pool and then priced accordingly. Libby, I think the second part of your question asked about the key cost drivers contributing to these increases. And from my perspective, there are really three main factors at play right now. The first is inflation. The cost of materials used to repair and replace damaged parts of a structure has surged. And while inflation has cooled slightly, the insurance industry tends to adjust a little more slowly. And that's because rates are still being set based on the higher costs of these materials. The second issue, and Steve touched on this, is weather losses. I mean, Minnesota stands out as one of the most challenging states when it comes to weather-related losses. We're experiencing stronger, more severe storms and larger, more destructive weather events, leading to substantial damage that insurers must cover. A New York Times story last May highlighted that Minnesota was the only state where insurers had lost money in each of the previous 5 years. Insurers are doing everything they can to stay in the market, which includes raising rates and adjusting coverage options, including increasing deductibles. I often say that the only thing worse than unaffordable insurance is unavailable insurance, and that's something that we saw play out in California. Unfortunately, we have a growing chorus of bad actors that are taking advantage of our severe weather. Roofing contractors are greatly inflating the cost of roof repairs. Insurers have to pay those inflated costs, and they are passed along to policyholders in the form of higher premiums. When you boil it all down, higher premiums are the direct price we are all paying for climate change. The third is legal system abuse. The legal landscape is a significant driver of rising premiums, particularly in multifamily housing. There are several cases that have raised alarms amongst insurers, especially as plaintiffs' attorneys develop legal theories that increase exposure in this sector. For example, building owners can be held liable for incidents on their property, even if they involve criminal acts. Imagine a situation where someone enters a building, attacks a resident, and the resident sues the property owner for not maintaining a safe and secure environment. A similar case in Georgia a few years ago resulted in a jury awarding $70 million as a result of that. And while I won't comment on whether that was a fair verdict or not, the fact is that $70 million was likely covered by insurers who must then factor such costs and exposures into future rates. Additionally, we've seen a rapid uptick in lawsuits and payouts from the surge of new businesses that deliver to homes and apartments, such as Amazon, DoorDash, Grubhub, Uber, Shipt, etc. There is more of this type of traffic than we have ever seen before, and it shows no signs of abating. And with that additional traffic leads to additional accidents or losses, such as slip and falls. That exposure must be figured into the cost of premiums. Now, all of these foregoing reasons have been enough to scare numerous insurers out of this line of business. And as we all remember from Econ 101, fewer options generally mean higher prices. We need to all be doing whatever we can to make Minnesota a more appealing place for insurers that want to do business and want to operate in our state.
Thank you, Aaron. And with that lovely segue, I'd like to turn to Commissioner Arnold. So Commissioner Arnold, you are responsible for regulating the insurance industry from the state level in Minnesota. Could you comment on what types of policies are regulated by whom? And then if you could take some of this conversation and take it into the national level conversation, how the regulatory community is talking about, thinking about, and understanding these cost increases we've been discussing.
Sure. Thanks, Libby, and thanks to the Fed for organizing this, but also for conducting the survey. This is really helpful to have additional data because, as Wei let us off, there's not a lot of data in this space. So we at the Department of Commerce oversee the insurance industry broadly. We make sure that companies that are in the market have finances that make sure that they're there when you want to pay your claim so that they, have long-term viability. We also look at the policies for individual premium or individual homeowners and auto. For larger businesses, we tend not to look at the specifics of those policies, but we are looking at the finances of the companies. We also look at rates on the individual side. So, I think that I'll take the second part of your question now. At the National Association, these are conversations we're having, with all of my colleagues across the country. We have done a couple of things that are kind of nationwide efforts, recognizing that each state has, problems or challenges in their market that are specific to the state, but there are some shared challenges. The first is that there's been a lack of data about the markets for a long time. The National Association of Insurance Commissioners, in partnership with the states, collected quite a bit of data last year. We're in the process of analyzing that, and then that is looking to become a more ongoing activity so that we can make sure we understand what's happening in our markets in terms of rates, in terms of coverage, in terms of availability. And that's something that we hope will continue because it's hard to make decisions without good data. The second is that in 2024, the NAIC adopted our first national climate resilience strategy for insurance, and that has a few goals. It's to drive faster and more effective risk reduction by state insurance regulators, but more broadly by state entities in the industry. It's also to ensure insurance continues to be available and reliable and affordable where it can. And then the strategy provides regulators tools and an action plan in certain areas. So this looks different in every state, but in general, it's looking at making sure that we are resilient to the effects of climate change, as Aaron mentioned, which is driving a lot of this increase. So our role at Commerce is to ensure we have a fair marketplace. And that means that we're balancing the need to have companies in the market with solid financials with the impact on people. The Fed study is consistent with what we've heard about, particularly from affordable housing providers, though we may not regulate their insurance. And it's in line with national trends, so it's in line with what we're hearing from our colleagues across the country. We want to make sure that Minnesotans can be safe and healthy in their homes, and that we have a stable and where it can be as much as it can be affordable market that supports housing for Minnesotans. And then I'll just zoom back out just a minute to the state level. So I'm a member of the governor's climate change subcabinet, and we've developed Minnesota's climate action framework. So that's an economy-wide look at actions that we need to mitigate and adapt to climate change. we have really put a ton of focus on building resiliency at community and individual levels so that both communities and individuals have the tools that they need to both mitigate and be resilient to the effects of climate change.
Thank you, Commissioner. A note to our audience, if you have questions for our panel, please put that in the Q&A tab that is at the bottom of the Zoom screen. Now, to our panelists, when we had our speaker prep call, we had a rich conversation about what could be done to address these policy increases, recognizing that solutions could be in housing, it could be in the insurance industry, it could be in other industries that are affecting what the situation is in multifamily rental housing. I'm going to give each of you the opportunity to provide 2 things that you are seeing as policies, regulations, practices that you would like to see that would be ways to address these policy increases. In our speaker prep call, some of you suggested that there is some optimism of things that are working that could have a positive effects going forward. And then other things that I think each of you are thinking about that might take more of a magic wand or lightning strike from abroad to come in and make the changes that are needed. So if each of you would like to share something that you're optimistic about, a promising policy or practice, and then second, something that would take a magic wand to implement. So with that, I'm going to start with Steve.
Well, I would say that let me echo Laura's comments about building a captive. I would love to be able to build a captive, but I'm a little too late to the game. It's going to take a long time to build up a capital stack. If you're in a captive, recapitalizing is a good deal. So I don't have that option available to me until I build up a capital stack for a captive. So my positive is that I'm investing in tenant protection plans because as Laura observed, most of my claims that are tenant damage driven are $100,000 or less. And I can mitigate my claims experience by buying a tenant protection plan from a group policy where we're spreading the risk over, 250,000 units nationwide and not geographically isolated. And that has been a very successful strategy. And part of the problem with affordable housing, I'm in a lot of LIHTC housing like Laura's firm is, if you require tenants to buy renter's insurance, it has to come off the rent. In other words, we pay for it if we demand that they buy renter's insurance. So the cheaper option for me was to just buy the tenant protection plan, which is like renter's insurance without any benefit for the renter. I get coverage for water, fire, explosion, which is about 99.9% of what tenants do in my units that I would rather they not do. And that helps my risk mitigation plan. And I market that to markets that are giving me coverage. And I think that's a future bright side to the industry, is that there's more of that becoming available, spreading the risk across a larger portfolio base. My magic wand ask is actually something that Commissioner Arnold might be able to address. I think admitted carriers and surplus and excess line markets should be held to an insurance appraisal on replacement cost value disputes with policyholders. If I dispute a claim, I have the right to go to insurance appraisal, but I don't have that right currently under Minnesota law to challenge the insurer on the replacement value. Now, they may play a cute game and just change their rates on the replacement 1,000 marker, but it's really unfair for companies to claim that I have a $350 a foot replacement when I can demonstrate I'm a $225 a foot to rebuild a building. And I'd like a review process that's state mandated that insurers allow for that. That's my magic wand idea.
Thank you. Laura, we'll turn to you.
Thanks. Yeah, I know we're all going to be stretching a little here on the silver lining, but there have been some. Overall, what I tell our team is, when we're in a more challenging environment, it forces us to do better. And it has forced us to do things like really get serious about preventive maintenance, really develop a security strategy, and really look carefully at our own data. It also, I think, and again, this is stretching the silver lining, but because we're hearing and seeing these kind of impacts, not only ourselves, but from our actual vendor partners who are struggling to work with us in some cases, particularly security vendors who are finding that they are losing coverage when their carriers know that they're working with supportive housing or a nonprofit or any kind of affordable housing. So there really are becoming ripple effects here. And I think there is going to be a greater and greater coalition that realizes we need to come together to figure out what the solutions are. On the magic wand side, I do think that particularly in terms of the impact residents have on this experience, not just on this, but in other ways in affordable housing, I am really trying hard to find ways and would welcome the cooperation of policymakers in this to actually reward residents that are abiding by their lease and are doing the right things, because I think they are their level of risk is underappreciated and underpriced. And as Steve said, they often don't see the benefits of their good behavior. And frankly, I would also like to find a way to have residents, particularly who don't have a security deposit at risk or may not be paying rent, have some skin in the game. So maybe we are experimenting with, are there ways that we can reward residents? Maybe we are literally putting money in escrow that is theirs if they leave on good terms or they get at renewal. But they lose if there are incidents that they are responsible for. So we are trying to think in innovative ways. My last point is, again, to echo something Steve said, there are some real policy disconnects in terms of incentives and outcomes that the policy makers would like to see, whether that are green outcomes, our coordinated entry system, which generally prioritizes hardest to house people who, again, may not be, excuse me, my light went up, may not be in a place where they are truly ready to be housed in an environment where they are not going to have someone that reminds them to turn the stove off and to close the windows when it's freezing. We provide a lot of supportive housing, but it is still independent housing. And if we have residents that are not going to be successful in that housing, we as policymakers and providers need to be realistic about what that housing needs to look like. If I end up having to evict a resident who caused a massive flood through negligence, where is that person going? We're not having that conversation. That I think is a disconnect with some of these outcomes that we're seeing in the insurance market.
Erin, promising practice and magic wand solutions.
Well, from my standpoint, one of the promising things that is happening is there's an increased awareness of our need to build a more fortified and resilient standard. And the commissioner talked about that earlier. If we can get to the point that people are using IBHS fortified methods of roofing and siding to better withstand wind and hail, and if we can get people to use impact resistant shingles or roofing, the risk exposure will decrease and will hopefully help to alleviate the premium pressures driven by these loss costs. Now, if I had a magic wand, I could solve half of this problem immediately, and that would be to stop wind and hail altogether. Unfortunately, I don't think that's probably going to happen. But some steps that are actually doable, if we were willing to do them, making some change in the tort reform space to drive down casualty losses is a really big one. Additionally, a desire to more quickly approve new insurers that want to do business in this state. I know there have been companies that have waited more than 4 years to get an approval to do business in Minnesota, some of which have been interested in writing in this multifamily space. And the more companies offering more options would be a tremendous good for this state.
In wrapping up this cycle, Commissioner Arnold, promising practice and magic wand.
I think mine are sort of two sides of the same coin. I think, I'll echo Laura and Erin. I'm really glad that we're having the conversations that we're having now. I think it's unfortunate that it took sort of really large premium increases in a lot of cases or coverage reductions to get to the conversations we're having, because we've known that there will be increases in wind and hail for a long time. But I'm glad we're being able, we're having these kinds of conversations now. And I think to echo what Aaron said, I think making sure we have a real focus on resilience and that we're thinking about preparedness, and not just at the individual level. I think that the things that Aaron mentioned, we have a Strength in Minnesota Homes program, which was passed by the legislature a couple of years ago, which sort of provides kind of a seed funding for a structure to copy programs in Alabama and other places to provide grants to low-income individuals to help with that. That's on the individual side, not the affordable side. But I agree, looking to some of the evidence-based standards that can help people be more resilient and structures be more resilient is really important. And then communities as well. I think, you can't have a community response to hail, but there are a lot of ways that communities can think about the way that they are investing in their housing stock or setting standards for their housing stock that make them more resilient to these types of big storms that we have, which are driving most of the increases.
I'm going to turn to some of the questions that have been coming in from our audience members. In building on this conversation about solutions, one solution that exists is a proposal to establish a task force to look into these issues around increases in property insurance. So I'd like to ask any of the panelists who would like to respond what you would like to see coming out of a task force. What issues, what questions would you want to see a task force looking into property insurance address?
Well, I think the issues of general liability availability, particularly as there's more surplus and excess lines market absorption, we have some issues in terms of carve-outs. The surplus and excess lines policies are not BOP policies per se because they don't have general liability built into them. So if you're buying a surplus and excess lines building coverage, you're also having to buy separately general liability coverage, and those sublimits on snow and ice, per occurrence deductibles out of alignment with where the market is. I don't think there's any actuarial science being applied to these particular policies that I'd like to see deployed a little bit more effectively, and task force could ask for that. The exclusions on animals, limits on assault and battery that are not landlord direct coverage. I think actuarial science needs to be applied more aggressively to how insurers are allowed to carry those broad costs specifically to liability purchase.
Mr. Arnold, I saw you drop off mute a moment ago.
That was an accident, but I will respond. So there was an affordable housing task force that had a few recommendations for the insurance industry. I know Aaron was on it, so maybe he looked like he was going to jump in, so I'll lob that one to him. I think if we were looking at a task force on affordable insurance, I think making sure that we're kind of having a broad discussion, which we've kind of pulled out little bits of here, of what do we mean is what is important for availability, what's important for affordability, and how are we kind of talking about that in our broader context given all the changes that we've seen. I think people are coming to what that looks like. As Laura mentioned, I think Laura kind of articulated a lot of the challenges that the businesses are seeing well. That will be a place where we're probably going to have to readjust some expectations across all parties, and that is something that perhaps some discussion of would be helpful. And then I'll lob my softball over to Aaron to let him talk about the affordable housing task force.
Yeah, I mean, thanks, Commissioner. I think that, as we went through the long-term sustainability of affordable housing last summer, insurance was talked about, but not nearly in the context of a number of these other things. And so, I mean, we're always happy to talk about what we can do to help alleviate these premium pressures. I'll come back to it again, and I've mentioned it in my two previous answers, but I do think it's so critical that is something we can actually do, which is legal and lawsuit abuse. I mean, reducing insurance costs is why we support efforts to curb the abuses in the legal system. Take third-party lawsuit funders, for example. These groups buy into lawsuits for a percentage of the judgment, seeking to profit off of injured parties. They have no incentive to settle cases fairly. Instead, they push for larger payouts, leading to expensive court battles, and they are solely focused on maximizing these returns. And these costs ultimately drive up insurance premiums. A study released by the U.S. Chamber Institute for Legal Reform at the end of last year found that the average household in Minnesota pays nearly $3,200 in tort tax, which is rising at almost double digits each year. And this is something the legislature can tackle. We need to address this issue so these trends don't further burden Minnesotans. And these reforms won't just help multifamily housing, they'll have a positive effect on homeowners and auto insurance as well. I often hear from people who kind of dismiss lawsuit reform as irrelevant to insurance costs, but we only need to look at Florida to see the positive impact it had. 2 years ago, Florida made significant reforms to its tort system. And what has happened since? According to a recent analysis by S&P Global, the effective insurance rate change in Florida in 2024 was just 1%. That's 3 times better than the next closest state. In contrast, Minnesota was one of only 5 states where the effective insurance rate change exceeded 20%. Nearly everyone in Florida credits this improvement to the changes they made to the legal system.
Thank you. So another set of questions that has come in is asking about the effect of reinsurance on policy increases. So some interest in both understanding reinsurance broadly, and then a question, what about a state-assisted reinsurance program? So Commissioner Arnold or Aaron, would either of you like to take this one on?
I'd be happy to talk about reinsurance because this is an issue that we deal with as well. There's no question that reinsurance premiums, kind of restrictions and parameters set down from reinsurers are cascading down to primary insurers, which is leading to some of this premium pressure and some of these restrictions. As you see higher deductibles and constraints on coverage, a lot of that is being driven by reinsurance. I know there's a notion of a state-backed reinsurance program out there. I don't feel that that's feasible. I don't feel that the state of Minnesota is going to be able to adequately capitalize a fund that's going to have any real issues on effect on this. I mean, if we're going to start at $1 billion fund, and after one storm, I mean, is the state wanting to dump more money into that? The issue is not availability of capital in this reinsurance space. There are a host of other factors, and that's not a solution to the problem, I don't think.
Anyone else want to comment on reinsurance?
Well, I'll just observe that, the reinsurance treaties, I think, are broadly written. And if we could get some traction on these treaties being somewhat more regionalized in terms of real risk, again, I come back to the actuarial science point. I mean, there isn't a lot of reason to ban green roofs if they're intensive green roofs. These are 18-inch soil roof protection devices, but the industry in the reinsurance market by treaty thinks these are these old 3-foot deep soil projects that ruined a bunch of office buildings in the 80s in New York, and they just haven't modernized. So yeah, I mean, I think reinsurance is an important factor for the local markets in measuring risk, and I think some education could be done out there. I think NAIC should be really taking the tip of the spear on that.
So another question that came in, we have a few questions from people who seem to own housing, and they have questions sharing some of their experiences. So one question that has come in, an owner of an affordable housing project was denied coverage by insurance provider who said that the number of evictions was high as an explanation for why insurance was, going to Aaron's comment, unavailable. So the question is, why would that matter to an insurance provider? If anything, it could be seen as a positive in terms of taking care of the property. So would anyone like to share their impressions of this particular challenge?
Well,
Steve?
I'll offer this.
Laura?
Oh, yeah, go ahead, Laura.
No, that's interesting. I have not had that specific experience, but I would be curious to learn more about that. Because we often do get the opposite, which is we are not removing difficult residents fast enough. So I think it kind of just reiterates, particularly here in Minnesota, where our QAP that guides our priorities for LIHTC funding is very specific in its outcomes. And there are some outcomes that are in conflict, or at least need to be reconciled with some of the outcomes that we then see in terms of the resident population and our ability to house them or to have to evict them when they are putting the building or their neighbors at risk.
Livia,
Steve?
I'll offer, I concur with Laura's comments. We in our portfolio, we aggressively evict for bad behavior, violence, non-payment. I'll just say this out loud. 2 years ago, the legislature adopted a number of tenant fairness, they couched it as tenant fairness, and changed landlord eviction policy substantially. And it's much harder now to evict someone. I mean, there's a 14-day waiting period statewide to evict if they haven't paid their bill. And now in Minneapolis, there's a 30-day waiting period. You know, this is just free rent that's being given away that's past cost. People know they didn't pay their rent. What's the mystery? But, you know, the standards of being able to evict people are very, very high now and very hard. And it's creating a barrier to getting good insurance. It's definitely dinging us on the affordable market because the perception is that these are risk factors that we're being artificially forced to retain for a longer period of time. That's simple risk mitigation. Needs to be fixed.
So in terms of fixes, a question that has come in again from someone who appears to be an owner of rental property indicated that they own some buildings that have solar panels, and those buildings have been turned down for insurance because of the solar panels. So the question is there some way of protecting owners who've chosen to put solar panels on to help the environment from an insurance perspective? Any thoughts on that question? Aaron?
Well, I'll jump in, and I think this connects to the last question because I think it goes to the importance of something I mentioned earlier, which is the need for additional writers in the state. Clearly, there are people who want more evictions and people who want less evictions, people who have an appetite for solar panels, people who don't have an appetite for solar panels. All of those are under the notion and the discretion of the risk that an individual carrier wants to take on. The more insurers that we can get into the space writing gives these owners additional options and additional availability to find a product that best suits their need. And I think that is critical in helping to solve this problem.
I think, Libby, that owners like, I'm in a position and I've offered it and it's been turned down. I've offered to self-insure any risks associated with a green roof or a solar panel, because it's a risk that I can manage and I know how to manage it and I know what the quantitative risks are. And I just got a blanket refusal. You know, I had 10 bids on a building. I got one policy proposal out of 10 because I had a green roof and a solar panel on the building. That's just not reasonable. You know, insurers should be able to recognize an owner with substantial insurance knowledge and capability should be able to self-insure those risks and carve it out of a policy on a manuscript basis.
Commissioner?
Yeah, I was the outright refusals for solar is a new one, so that's something we'll have to look into. As you know, the converting our energy to be less carbon intensive is an overall goal and something we work on in the insurance or in the energy portion of our department. So that's one we'll dig into. I think you know, as Aaron mentioned, having writers is helpful. We prioritize writers that want new business and want to write these kinds of business in the state. And so, you know, there are certain standards around making sure that someone can write business in the state. But we are trying to, you know, sort of prioritize those applications as we go through. So I think that it's something that we'll need to continue to have conversations on, but certainly is, I think, should be workable. These are known technologies and something that's not just a priority from an environmental perspective, but it really lowers businesses' costs when you have solar on it because you are, you know, you no longer have the utility bills that go along with it. And that's something that we hear a lot on our energy side of our department. And so certainly want to make sure that there are opportunities to lower other kinds of costs, particularly when there's a challenging insurance market.
So with that, We are almost out of time on today's webinar. I would like to deeply thank all of the members of our panel for having a rich conversation, for being willing to engage both in the research that the Minneapolis Fed was able to do in this question, and to think about what policy and practices could improve the situation for housing owners and operators. So thank you to each of the four of you for your time and energy today. And with that, I will turn it over to my colleague, Wayne Nguyen, to wrap us up. Thank you.
Thank you, Libby, for moderating such an insightful discussion to explore the impact of property insurance costs on housing supply and affordability. I would like to thank again our panelists, Commissioner Grace Arnold, Aaron Cocking, Steve Min, and Laura Russ. Housing affordability supports household stability, employer growth, and economic and community vitality. And housing is the largest cost for most households. That's one of the reasons we conduct research, convene experts, and engage in our community to better understand housing affordability and all the cost components that may be included, which I think every single panelist here highlighted all the different considerations and all the different cost components. So thank you again for joining us. I want to thank the audience as well for joining us. Please be sure to take the survey at the end of this webinar. We want to make sure that our events are of value to you, and any comments that you might provide us will just make sure that our future events are of value to you. So again, thank you so much for joining us and have a great day.